Hi everybody, this is Ellman, the blue-collar investor, with today's covered call writing question of the day. Today's question comes from Marcus, who has an idea about trading covered call options during the course of the day, or day trading covered call options. Alan, I love your tutorials on covered call writing. I'm a novice in the trading world, and I'm very excited to try options trading. I just have a question that I hope you can answer or point to one of your videos that may contain the answer. So, I own 300 shares of ZNGA and want to sell just one contract in the money covered call option. If I put this order in on day one, can I collect my premium, buy back my one contract, and just continue doing this kind of transaction throughout the day as an exit strategy? Many thanks in advance. Signed, Marcus. Well, Marcus, the short answer to your question is yes, you can. You could sell the option, buy it back, resell the option, buy it back as many times during the course of a trading day as you would like. The real question here is whether that makes financial sense. Will we make money if we use this type of strategy? So in order to figure that out, let's first take a look at the options chain for ZNGA at the time that I'm creating this video. As you can see on the screenshot in front of you, ZNGA is trading at 321, and you had mentioned in the money call, so let's look at the $3 strike, and you can see the $3 strike has a bid of 29 cents and an ask of 31 cents. So what that means is when you sell the option, you're going to generate $29 per contract, less commissions, and to buy it back, you would have to pay $31 plus commission. So if you sold the option, your initial return, you'd have to deduct the intrinsic value from the 29 cents. Intrinsic value is 21 cents, the amount that the $3 strike is in the money. So that would give you a time value profit of $8 per contract, or 2.7% 1 month return, less commission. So far, so good. Now the question is, can we buy back this option and continue buying and selling the option during the course of the trading day and actually convert this to profit? So in order to answer that question, we're going to have to know how much the option price is going to move as the price of the stock moves. So for that, we need to access delta information. Delta is one of the Greeks, and it will tell us how much the price of the option will change for every $1 change in the price of the stock. So in the screenshot that I created in front of you now, you could see that the delta for the $3 call option on ZNGA is 0.71. That means for every $1 change in the price of ZNGA, the corresponding $3 call option will change by 71 cents. So we take that information together with the information that we gleaned from the options chain, and let's see how we could make some money day trading covered call options. So let's have a look and see what we have to overcome in order to make this profit. We know that ZNGA is trading at $3.21, and the $3 call option will generate $29 per contract. The ask was $31, so we have to overcome a $2 difference in the bid-ask spread. So we would sell for $29, buy back for $31 in a short period of time. So we have to overcome that spread. Now, in addition to that, we have two trading commissions, buying back the option and reselling the option again. Let's use a conservative $8 per trade, or $16 for the two trades. So that means that to break even, we have to overcome $18 per contract before we actually start making some money. Now, that's 18 cents per share, per option share. So that means with a delta of 0.71, the price of the stock would have to go up 25 cents in a very short period of time. Now, for stock trading at 321, that represents a 7.8% increase in share value in a very short time frame. That's what we would be depending on just to break even. And that, as you know, is highly, highly unlikely. So let's summarize here. And as you know, that I always encourage our members to think outside the box, as Marcus has in this particular case. I really admire that quality. And when that happens, one of two things is going to occur. Either we're going to find a great idea that we're going to incorporate into our trading strategy, as some of my ideas have been over the years, I hope you believe, or you're going to find that it's not such a great idea, but yet you've learned something from it and made ourselves better traders, as many of my ideas have over the years made me a better trader, even if I rejected it because I realized it wasn't such a great idea after all. So let's see which category that fits into. We know that day trading covered calls generally will not work because we must overcome the bid-ask spread in a short time frame. Not only that, but we must overcome trading commissions, which is particularly challenging for a low-price stock like ZNGA, which means the trading commission will impact the final results because the percentage impact it has on it will be much greater. In order for this to work, the stock must whipsaw dramatically in a very short period of time. 8% we calculated from the delta stats that we showed before. So what's the takeaway here? Well, the takeaway is that covered call writing is a conservative strategy for conservative investors, and we should not try to convert it into a risky strategy. It just will not work over a long period of time. But kudos to Marcus for coming up with the idea and thinking outside the box. As I said, Marcus, I really admire this type of thinking, and thanking you for asking the question. And thanks, of course, to everybody out there for taking the time to watch this video. I hope you enjoyed it, and I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.